Hello everyone, this is Jatin from gladtutor.com, and today we are going to talk about the capital structure in financial management, which includes its meaning, factors affecting, and the four theories of capital structure that are net income approach, net operating income approach, traditional approach, and Modigliani and Miller approach. So this is the part 8 of our financial management series. In our previous video, we have talked about the leverages in financial management. To watch that video, check out the upper notification, and to check our all previous financial management playlist, you can also check out the upper notification. So if you are new to our channel, then don't forget to subscribe Glad Tutor and turn on the bell icon, so that in future if we upload any video regarding financial management or any other management subject, you will be notified. So without wasting so much time, let's get started. So firstly, we will talk about the meaning of capital structure. So capital structure is a way a company finance its assets with a combination of debt, equity, and preference share. So in capital structure, the company uses the combination of three things: debt, equity, and preference share. And you can say that it is also known as a financial leverage, because in the financial leverage we do make a proper balance of debt, equity, and preference share. If I give you example that if I am for a company, I am using equity and preference share, then the venture should also be issued, because there should be a proper balance. There should be a debt equity ratio, because the financial leverage decides the ideal capital structure, which is the debt equity ratio, and debt equity ratio is 2 is to 1, right? So this is about the meaning of capital structure. So now come to the pattern of capital structure, that how a company do or finance their funds. So the pattern of capital structure can be through equity shares only, that company is issuing only the shares through equity and preference shares, or company is issuing both equity and preference shares, and company is issuing only equity share and debentures, or company can also issue all these three things, the shares and debentures, which include equity shares, preference shares, and debentures. So this is about the pattern of capital structure. So now we will talk about the factors affecting the capital structure in financial management. So the first factor is the trading on equity. So firm must be careful while issuing the shares or debentures, because there should be a proper balance between both of them. If they are not making the balance, then the trading on equity is not good. So the next one is growth and stability of sales. If the firm growth is good, or if the firm has forecasted their future sales good, then the firm should go for the capital structure. Third one is the cost of capital, expected earnings, ROI. The cost of capital, minimum average rate of return you are getting, expected earnings, and what are the return of investment you are getting. It also affects your capital structure. Nature and size of firm, all probably like the about your what is the size of your firm, and the nature also differentiates the capital structure. Because if we compare the public utility firms and the manufacturing firms, public utility firms issues more debentures, but the manufacturing firms issues less debentures. So next one is control. Wherever additional funds are required, management generally want to raise the funds without any loss of control over the firms, right? Flexibility, according to the situation, always change the debt equity ratio. Don't just stick to the rule. If the firm is required some changes in the if the firm wants to issue more debentures, then you should do, or you should be flexible enough for that. Investors, yeah, that can be a factor for that affect your capital structure. Economic conditions, economic condition also affect the capital structure, like during recession the firm can't go for the fresh shares, right? And legal restrictions can be a great factor. Purpose of financing, and what is your purpose, like whether you want to issue more debts, you want to issue more equity, there can be a different purpose according to different companies. period of financing, for how much time you are looking for finance, for a mid-term, short term, or long term, then that can be a factor of affecting your capital structure. Now come to the theories of capital structure in financial management. There are four theories, that are net income approach, net operational income approach, traditional approach, and Modigliani and Minnell approach of capital structure. Now come to the net income approach of capital structure. According to this approach, a firm can minimize the weighted average cost of capital and maximize the value of firm by using the debt financing to the maximum possible extent. So what this approach says, that the if you use more debt, then the value of firm increases and the cost of capital decreases. So as more investment increase the profit, so if we use more and more profit, the value of firm increase because it decreases the cost of capital. So the main crux of this approach is, if you use more debt, then the value of firm increases, cost of capital decreases. This is the crux of net income approach. Now come to the assumptions of net income approach. The first assumption is that the cost of debt is less than the cost of equity. There are no taxes. Perception about the risk of debenture is not changed. So as the proportion of debenture increases, the proportion of less expensive sources of fund also increases, and it also decreases your cost of capital and increase the value of firm. Net operating income approach. So in as in net income approach, if we use more debts, the value of firm increases and cost of capital decreases. So this approach is totally opposite of the net income approach. According to this theory, change in capital structure doesn't affect the market value of firm. Overall cost of capital will remain constant irrespective of the method of financing. So according to this theory, increasing using of debt increase the financial risk of existing shareholders, and the cost of equity decreases. And on the other hand, cost of debenture remain constant with the increasing use of debt. So financial risk is not affected. So according to net operating income approach, if we use more debts, it increases the financial risk of existing shareholders, and also increase the cost of equity. So on this approach, the cost of debenture remain constant with the increasing use of debt. So this is about the net operating income approach. Now come to the assumptions of net operating income approach. So the first assumption of this approach is that the market capitalize the value of firm as a whole. Right? There is no corporate tax. Business risk remain always constant at every level of debt equity mix. Whether we issue more debentures or whether we issue more equity, the business risk will be same. Single factor doesn't affect the value of firm. So these are the assumptions of net operating income approach. Now come to the third approach, that is traditional approach. It is also known as the intermediate approach, because this approach is half agreed to the net income approach and half agreed to the net operating income approach. So according to this theory, the value of firm can be increased or the cost of capital can be decreased by using more debts, because as a debt is a cheaper source of finance than the equity. So optimal structure can be achieved by a proper debt equity mix. But if you beyond that level, the cost of equity increases, and the increasing using of debt can increase the financial risk of existing shareholder. So the benefit of using cheaper source can be offset by the increasing use of debt cost of capital. So what this theory says, that the if you go to a particular limit for the using of debt, the first approach can be a true. Your value from can be increased, your cost of capital can be decreased. But if you go beyond that limit, the second approach will come here. Then the according to second approach, your existing shareholders financial risk will be increased, and your cost of equity will also increase. So traditional approach, that's why it's been said that it is an intermediate approach, because it agrees to both net income approach and net operating income approach. Now come to the most important approach of you can say theory of capital structure, that is Modigliani and Miller approach of capital structure. There are two cases for this approach. First one is if there is no tax, right? If we doesn't include tax, then this theory is agreed with the net operating income approach. If there is tax, this theory is agreed with the net income approach. So now firstly we will talk about the in the absence of tax, like there is no tax, so that will be net operating income approach. So this theory will also cover all the assumptions of the net operating income approach. In the opinion of Modigliani and Miller approach, two identical firms in all respect expect their capital structure can't have different market value and cost of capital because of arbitrage factor, right? So in the opinion of Modigliani and Miller firms, the two firms, identical firms, irrespective of their capital structure, their market value and cost to capital will can't be different, right? So in case they have a different cost of capital or a value firm, if he says that the arbitrage will take place and investor will engage in the personal leverage rather than the corporate leverage. So this will render the two firms to have the same total value. So it's been said that in this approach that the value of firm market value will be same for the two identical firms always. It cannot be different, right? If it is different, then the investor will engage in the personal leverage, right? They will not do the corporate leverage. They will be interested in their personal leverage. Why they will go for corporate? Assumptions of this first no tax approach is there is no corporate tax, there is perfect market, investors act rationally, the expected earning of all firms have identical risk characteristics, and all earnings are distributed to the existing shareholders of the company. If we assume that there is a tax, then we will go to the net income approach, in which the value of firm increases and cost to capital decreases by using more debt. So there are two things: value of a leveraged firm, value of unleveraged firm. If you talk about the unleveraged firm, then the formula will be EBIT, earning before interest and taxes, bracket 1 minus tax divided by KO, that is cost of capital. That will be formula for the unleveraged firm. If we talk about the leveraged firm, the formula will be value of VU, here stands for value of unleveraged firm, which we calculated before leverage. So we will put the value there plus TD. T here denotes tax and D here denotes the quantity of debentures. So here we will get the value of leveraged firm. So this was about the theories of capital structure and financial management. So I hope you have liked this video. If you like it, make sure you like, comment and share this video with your friends, and don't forget to subscribe our channel Glad Tutor. If you have not subscribed, please subscribe and turn on the bell icon so that in future if you upload any video you will be notified. Thank you.